Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 41. As always, joined by the three amigos here. We got Keith Digger of IceCap Asset Management, and of course, the Tom Brady of Macro in Whistler, VIP in Whistler, Rich Diaz, Acorn Macro Consulting. Welcome back to the show, gentlemen. What's going on, Rich? You got the Summer of Love tour.
That's right.
Yeah, what's going on there?
So another wedding. I think everybody's catching up on weddings post-COVID in Whistler right now. It's freaking beautiful. It's weird to go to a ski mountain in the summer, but it's amazing how much is going on here. First of all, the biking, there's a million downhill bikes just like buzzing around. And that's
Have you ever
awesome.
been to Whistler?
No, never.
Oh, there you go.
Yeah, so it's pretty cool. The drive up was amazing. That was like just an incredible drive. Yeah, it's all new to me. It's beautiful here, man. You guys, this is a really, really awesome part of Canada. So I would recommend everybody to come out.
If you need a house, let me know. We can make it happen.
Can't afford it.
Keith, what's going on, buddy?
Yeah, same thing. You know, you guys are doing the whole wedding thing. And at my vintage, that's not happening anymore. If it is, it's like the second weddings, I guess. That's what you're looking at.
You're at all the funerals now.
Yeah, I'm getting up there. That stuff happens. Anyway, yeah, we're all smiling. We're good here.
Yeah, well, let's jump into it because I don't know if one should smile here, but we had Canada's CPI inflation print come in yesterday as of this recording. What is it? 8.1. I think the market expectations were calling for 8.4. So the silver lining was it was below market expectations, but I believe it was still a 40-year high in inflation. So it's kind of like, yeah, I don't know whether to be happy or to be sad, but I personally was looking at it and saying, okay, well, it missed expectations because the market was already kind of pricing in basically 8.4. And so are we, at some point, like I had this debate on Twitter and I'd love to get into this with you guys, but like, I feel like there's a strong cohort of people that don't really understand like rate of change terms. Cause like I basically was on Twitter and I was like, listen, I think we're making a turn here, and everyone just like dog piled on. And I think like everybody is on the one side of the boat, which is like inflation. It's here. It's never going away. We're going to double digit Weimar Republic. And my view is that, you know, I think all of us were like very early on the inflation call. Like we all had inflation since we started the show. We're on 41 episodes now. And my view has been that at some point from a rate of change terms, it's hard to beat last year's comps. And so once you get up to 8, 9, 9.5%, it's like, well, inflation has to accelerate that much more for you to beat last year is basically comparable. So that's what we say is when we say inflation is going to start rolling over, it's going to go from 8.1 to 7.9 to 7.4, and it might just stay at 5.5 next year. But it is declining. I think that's what the central banks are looking for. They're looking for some air cover basically, so they can at least, you know, pause or be less hawkish on their interest rate policy. But Rich, I don't know if you're looking at it. I don't know if you want to unpack the inflation numbers for us a little bit further.
Sure. I mean, just before we get into that, I think there's two things that humans, and I would include myself as one of them, or have a hard time wrapping their head around. One is probability distributions. So if you like ask people like, what's the probability of something occurring? I don't think humans are good at like trying to navigate that distribution. You know, like it's a 30% chance of this happening, or 1 in a million, or like the chance of winning the lottery, or whatever it is. And the other thing that I think people have a hard time wrapping their head around is rate of change stuff. So, and I'm guilty of it too, you know, and so when you see that curve, when you see it rolling over, as we'll get into in a second, it's hard to do the math, you know, sequentially over time. But anyway, so just go over it quickly. The headline, as you said, was 8.13. Core obviously just kept going. But one thing that I like on the positive note, so let's, it's the summer, it's beautiful outside, let's be sort of positive, is we've talked a lot about the shelter component, which is 39% of the core basket, I think. And that has been, for me, the number one, reason why I think it's not transitory, forgive the word. And that actually started to roll over a little bit. As you said, the rate of change has slowed. So that I thought was really important. That's slowed to 7.1%. So still really, really high. But the contribution, which is, again, 39% of the core shelter basket, has actually slowed a bit. So it's no longer at peak contribution, quote unquote. The other thing that I thought was important was food. Food is also a significant portion of the basket. Obviously, if you have less money, it's more important. If you make more money, it's less important. But that also started to roll over. So two things that you can start to see are actually starting to peak out, as you said. Inflation expectations, something that came out a little while ago. So there are surveys done by the Bank of Canada that ask people what their expectations of future inflation are. And that came out. That's a quarterly series. They ask consumers, they ask businesses. And a little while ago, that is still massively, massively high, sort of an all-time high on the series. So I think we'll have a situation going forward where you have the inflation numbers actually start to, again, roll over. The rate of change gets slower, but the inflation expectations actually hang out there a little bit. And so those are my observations. I don't know, Keith, if you had anything to add.
Just an observation on the rate of change. I think it's a fantastic concept for everyone to understand. Because markets move out, what was the last change in any number? So as an example, we had success this year with not being hurt too much with markets come down, because last year we were able to clearly see that the rate of change of M2 growth by central banks, like how much stimulus for the central banks pumping into the system, and we could see that rate of change was about to roll over. And when that happens, usually it means it's a risk off event. So, markets trade off and stuff like that. But if you were just looking at the absolute headline number, you'd say, man, the Fed, they're still gushing money into the system. The Bank of Canada is still doing it and all that. But you can take the rate of change approach with anything. So remember, it is not the absolute number that matters. So I know the inflation number yesterday, what you guys say it was?
8.1.
8.1, yeah. So just say we go fast forward a year from now. If it's still at 8.1, it means it's up 8% from today's, absurdly high number. So again, that's something for people to
I've got another pickup line. The second derivative.
There you go.
So another thing that people like to look at, which is a bit quanty, a bit nerdy, is to look at the rate of change of the rate of change, which is otherwise known as the second derivative. And we'll start. And so some people use that, for example, when they're looking at the Chinese credit impulse, they'll do the rate of change of the rate of change relative to the GDP. And that is what people look at as far as what Keith's point was. As that's rolling over, you've got this second thing. And I think that's like calculus 4 or 3 or whatever it is, high school math. I was not good at it, but it's something we definitely look at. It's in my credit impulse. If you follow me on Twitter, you'll see that. I pump that out sometimes. But that's another way of looking at the rate of change to see how that's slowing. But anyways.
That's a great point, because that's actually something I personally will look at and use for when I look at house prices. So if you look at residential mortgage credit growth, the rate of change at the second derivative of residential mortgage credit growth is typically a very strong indicator towards the growth in home prices. Obviously, if credit growth is growing, it means people are borrowing money to inflate house prices. So, and that's actually modeled very well by Professor Steve Keen, who's written a couple of excellent books. I've had him on our show, or my show, several times. Not in the Loonie Hour, but a separate show. And extremely smart guy. So the second derivative rate of change, not to geek out on you guys too much, but Rich actually had a funny thing, because so it's a couple people DMing me on Twitter after that CPI miss, and people are getting all upset, saying the numbers are fudged, and but one of the things I think we've always been skeptical around the CPI basket, but so shelter costs, it says here, this is from Bloomberg, shelter costs gained 0.4%, the smallest increase since November. That reflects in part lower real estate commissions as the housing market slowed, Stats Canada said.
I mean, that's the thing about these numbers. I mean, people like to bitch about them. I certainly do. but I would challenge all these people to come up with their own CPI number, number one. Number two, I think it's not about trying to it's not about hand wringing. It's about understanding what you're looking at, where it succeeds in describing the reality that we're living with. And it's important to just recognize where it fails. That's why you look at more than one indicator. That's why you look at more than one inflation number. Something I like to look at is something called the implicit price deflator, which is a word I could never ever string together. But that's the inflation of the entire economy, which does not just include consumer prices, but includes export prices, import prices, includes government spending, capex. And that's another way of sort of just double checking that number. And then there's PPI, which, by the way, has rolled over a while ago, as we've discussed. But yeah, I don't know, Keith, I don't know. I don't think it is helpful to be critical of those numbers, but I think sometimes we spend too much time, bitching about how they do it. These people are smart, Stats Canada, there's a lot of really committed, intelligent people. It's a hard thing to do.
I mean, like down in the States, they have, what's the guy that does the shadow inflation
Shadow
data?
stats.
Yeah. What's his name? John?
I can't remember.
You should just use the Big Mac index.
The Big Mac index.
But that shadow index has been debunked, I thought. No?
Well, but I mean, I always look at that thing to say, official inflation is at, call it 8%, my headline numbers. And people say, there's no way it's at 8%. And then the shadow stats guy is saying, well, it's really at 25%. and that's, that's fine as well. But it's really irrelevant because the 25% level, like a year ago, maybe was at 18%. Again, you go back to that rate of change. What was it back in the O's and then the 10s and the 90s and that stuff. And that's when it really comes down to, but the bottom line is, lower income households have been getting screwed. Like they've been allocating increasingly more of the money to buy food and for gas and, for heating, electricity, you name it. And that's having a big impact. And I think now we sort of, if this rate of change does happen on the inflation side, it might also sort of play in, with the whole slowing growth or recession story at the same time, which sort of brings us, I think we need to jump over to Europe next. Maybe.
No, not yet. We're almost there.
Yes. I can't wait.
Keith is chomping at the bit, salivating over that 50 basis point hike, which we'll get into in a minute. But just kind of going, basically, I almost think like we always kind of open up the show on like the Canadian front, and then it like jumps into I think almost we need to have a crude oil segment, given that we are Canadians, and give Rich an opportunity to rant. But I don't know if you saw there's that piece going viral from the CBC News. They're like finance person, or they're like financial advisor, sort of editor,
treasury,
or whatever.
Yeah.
Well, no, like the person that like gives like financial advice, like she's like, that's her shtick.
Okay, cool.
At CBC, like her advice was basically she's like, yeah, like for these people that are struggling with inflation in Canada, just go and ask your employer for a larger raise or find a new job. So that's the solution. And of course, our policymakers' solution is just to hand people more money. Speaking of which, I actually got a check in the mail. No joke. I got a check in the mail, Keith, yesterday. So our car insurance company, so ICBC, the government insurance for your car here, they're cutting everybody like $110 check for gas prices. And they've done I think this is the second installment. I drive a Tesla. So I just pocketed the money, I guess. So Rich, beers are on me when you come back through town here. I ride a bike. Yeah, I don't know what's else going on. I mean, I'd love to chat briefly on a little bit quickly on the housing front, and then we'll switch gears into the Eurozone there. But yeah, I think, as these rate hikes persist throughout, I don't know, do we have an update, Keith, on what the market odds is? It 75 basis points expected right now for BOC in September?
Yeah, so the next meeting is September the 7th. Right now, it's slightly less than 75 basis points.
Okay.
So,
but it's going to be basically what we're saying is essentially we're like almost a lock for 50, let's say.
Correct. So it'll be another good Twinkie bet.
Yeah.
Because it's sort of on the fence. Will it be 50 or 75? It will not be 100. and it won't be 25 either. If something happens between now and then, it could be nothing, right? That's
I mean,
how,
that's
where we are now. So I know it's a Canadian show and we focus on Canada all the time. But a lot of these events can really come back and affect Canada. Let's just say within Canada for a second as well, though, because I know after we had last week's Bank of Canada meeting. Are you guys hearing anecdotal stories about like people on the street, your family, your friends talking about the rate hike and housing, or is it a non-story? Yeah.
No. Some a friend of mine, I won't give you too many details, but a friend of mine just bought a house, was told to get a variable rate mortgage because they would qualify for a larger mortgage. Basically, again, this is not my lane, so forgive me if I'm screwing this up, but he came up to me and he's not super in tune. He's like, dude, what happened? My mortgage went up by a significant amount or whatever. And he's like, we felt it. Or like, and the other thing, another person said was like, a real estate guy, really fresh to the game, right? Really young. And he's like, yeah, they're the sort of what people have been able to purchase, given the stress test or whatever, has been knocked down. And he's like, that's totally taken the air out of the market in Halifax. So I don't know, Steve, I know I got out of my lane there a little bit.
No, I love it, man. You're dialed in. I mean, all I can say is like, so after that 100 basis point rate hike, I think we talked about it briefly on last week's show, which basically is like overnight, if you were like planning to go with a variable rate, you lost 10% of your borrowing capacity.
There we go.
Because you had to get you pushed up into the stress test. So you're basically getting qualified at about 5.2%. After that rate hike, it was pushed up to just north of 6%, about 6.2%, right? 100 basis points. So you lost. So we actually I saw it, like not just myself personally, but like, realtors in our office, deals were collapsing. Because people had accepted offers and then they went to go and then, because what happens is you can't like hold that rate as a variable. So you have to requalify. So they had to then requalify all of these files at this higher stress test. And all of a sudden people no longer qualified for the properties that they were intending to purchase. So we're seeing a lot of offers collapse. I've been chatting with chatting with a whole bunch of the top producers. Think of like the top agents or top real estate teams in the city of Vancouver. I've just been chatting with a lot of them over the last, week or two. Like some of these guys, if you've been chatting with them, they've been in the business for 20 plus years and they're telling me that this is the weakest housing market they've seen. So they say, go back, look at 08, 09, go back, look at 2012, go back, look at 2017, 18. And they're like, yeah, this has been the weakest market. And like, again, we're only 4.5-5 months into a correction here. So yeah, things are unfolding and we talked about it. I'll be the first to admit, like I said, I got the rate hike call wrong. But like all these big banks coming out with these like optimistic, rosy forecasts in the housing market. I said, as soon as rates get north of 3.5 into that 4% territory, the housing market is going to crumble. And that's exactly what's happening. So we'll see. I think once they add another 50 basis points here, I think that's going to be a train wreck because again, you're just going to push your variable rates even higher. And that's been kind of the escape valve for a lot of these borrowers over the last 6 months.
Can I ask a quick question, maybe a dumb question? So like we've talked a lot about residential real estate and sorry for the digression, but in commercial real estate, is it the same dynamic or is it a different set of spreads and credit constraints and the lenders feel differently because there's cash flows associated? Is that?
Yes and no. It's all very similar, right? Like they definitely factor in like, it's a totally different market. So I'm not going to pretend to be an expert here. But I mean, it reprices buildings entirely, right? Because like you're using basically like cap rates and saying, well, hold on a minute. Now the interest rate is what? So yeah, we've seen a doubling there, but yeah, typically speaking on the qualification side, we're tending to look at more so at cash flows, debt servicing. So
and
they're basically
vacancy
looking
rates.
They're looking at a building as like a business, right? So like,
fair enough. Okay.
That's typically how they lend versus like, your personal balance sheet on the residential side.
Okay.
But Keith, your boys in Europe, the economic fantasy land,
drink.
Are you? Yeah, drink. Are you surprised? Yeah. Somebody, by the way, whoever
Bingo.
made the
Bingo.
Loonie Hour bingo sheet
is amazing.
Yeah,
I know.
fun.
Thank you
I
for
know.
whoever did that. As
We're gonna have to
And
get this.
everyone's watching this on Friday or Saturday. We do this on Thursdays, by the way, so we're not ahead of
drink.
we haven't finished the week.
Nice.
Yeah. So let's switch over to Europe, guys. And so the way this is connected to Canada, we've been talking about this now for a while. Was when we first started the podcast, what was really great, we were introducing to everyone that things can happen outside of Canada that can affect Canada, and because there wasn't a lot of stuff happening inside Canada at that time. And now over the 41 episodes that now we've done this, I like to say we're now seeing the world has become synchronized in that everyone has now this risk. The probability is a lot higher than it was before. So obviously in Canada, with rates going up and housing rolling over, it can affect employment, the knock-on effects. The banks can get a bit hurt, and everyone's RSPs have come down a little bit and things like that. But the number one risk that that I like to talk about all the time is continues to be Europe, and that's why we call it that really cool name, because that's what we do at IceCap, where we say cool things. Today was the ECB meeting. So next week we have the Fed, and after the Fed's meeting, that's it. The summer is everyone's on holiday then. So all the central bankers will come back in September, but we're going to have about 6 weeks where there's radio silence by the central bankers and things like that. So this was a good one today from the ECB. What they did in typical European fashion or style, they got style, right, Rich?
They do have style.
They do have style. People say I have style too. So
no one says that, Keith.
My mom says I have style, but so what the ECB did today, they raised interest rates up to 0%. So we got to let that sink in. But they raised interest rates.
What's the official inflation rate technically now? Like 8?
Yeah, they're in that 80s range, but they went from minus 0.5% now up to 0%.
So they're running real negative rates of -8.
Yeah, absolutely. And they sort of guided they're going to do 25 basis points, but they did 50, and that was like, okay, wow, we weren't expecting that. And but then the big, there's always a twist with the Europeans. It's fluffy. Everything is always fluffy. It's never one thing with the Bank of Canada. They say, hey, we're doing 100, and this is it. Like it was, it came straight at you. The Europeans do it in a different style. So first of all, they raise rates because they think doing that can cut back inflation. Now, I don't know how the ECB raising rates is going to pull back European inflation, which we will go into that in a little bit, where all the European inflation is coming from. But what they also did in Europe right now, they have this real problem in that, the economy is slowing, inflation's going up, bank lending is declining, spreads are widening. Sovereign debt spreads are widening, so it's costing countries like Italy more money to borrow than it did, last week and the month before that, and everything. And at the same time, politically, we'll hop into that as well. So Europe is in trouble, and when the ECB, when they get in trouble, they have this program that they will introduce. It's always a new program. So just to demonstrate, so I think in Canada we may have had one program by the Bank of Canada, whatever they came up with for the pandemic. And the Fed had, TARP back in 0809. I want to read out a list of the European Central Bank stimulus programs. And some of them are not, yeah, I know. You don't need a coffee. You may need a glass of Pinot Noir or something like that. Okay, here we go. So we have the IMF, International Monetary Fund bailout, the World Bank bailout. We had zero interest rate policy, negative interest rate policy. We had the European Financial Stability Facility, the European Financial Stability Mechanism, which is different than the facility, of course. We had the European Stability Mechanism, which is different than the European Financial Stability Mechanism. We've also had the outright monetary transaction. We had the bilateral agreement. We had the balance of payment program. We had the Greek loan facility. We had the targeted long-term refinance operation program. Then we had the targeted long-term refinance operation program 2. And then the Targeted Long-Term Refinance Operation Program 3, they call them the T-LITROs. And then we had the PEP, which is the Pandemic Emergency Purchase Program. And then we had the Public Sector Pandemic Program, which is different than the Pandemic Emergency Public Program. And now, yeah, you're all laughing because you should be, because now we've had like 10 plus years of this and nothing's been resolved over in the Euroland. So today, to really try to draw the line in the sand, so they raise interest rates to try to bring down inflation while the economy is slowing and everything else is in trouble. But today they announced another new program. This one's called the TPI. So it's the Transition Protection Instrument. I might have that a little bit wrong. It's another word
Say
salad.
it again. Say it again. Say that 3 times fast.
Yeah, the Transition Protection Instrument. Transition Protection Instrument. Transaction Pro. I'm just joking now.
I need one of those.
Yeah.
This is a Monty Python skit with the
I know.
People's Front of Judea, then Judea's People's Front, and then anyways, keep going.
It keeps going up. But here's the key thing. Okay, now let's hop back into the real world. Whenever you have any kind of a fund or a transaction, anything, you have what's called a term sheet. That's how our world works on. If you're buying a house, you guys may not call it a term sheet, but it's a term sheet. And on the term sheet, you have specific numbers and conditions listed there. The term sheet for the, I don't know, is it transaction or transition? Look it up. What is? I need to know this. I should know these things.
TPI.
It's
TPI,
transmission. Baby. Yeah, sorry. So the term sheet for the Transmission Protection Instrument, it was released today by the ECB. It's all qualitative, so there's no numbers in there. So effectively, what it is, and I think the market will catch on to this later today and tomorrow. It's similar to what the Japanese just did. It's open-ended QE.
What does that mean?
Well,
like open-ended is like we don't have a target. We're just going to just buy as much as whatever we feel we need to buy.
Is that yield curve control?
Yeah, absolutely. Whereas like regular, isn't it funny? Regular QE, like 12 years ago, there was no QE. And then it become, I always laugh as well. You know, people working now, I've been 10 years in the industry and I'm really smart. I'm like, yeah, but your whole career has been in a period with negative rates and QE.
This is honestly hilarious, man. I had guys dunking on me yesterday too. Like I just love getting dunked on Twitter lately. But like guys are like, what happened to your financial repression call? And I'm like, man, like
that's what it is.
It was like inflation's at 8 in Canada, the BOC is at 2.5. Okay, first of all. And then you've got Europe, but now at 0 with inflation at 8, and they're still running like TPI or whatever the hell you call it, which is open-ended QE. Like, tell me that's not financial repression, and or some form of version of yield curve control.
So yeah, so regular QE, that's when say like the Federal Reserve say, hey, we're going to spend, say $50 billion a month to buy treasury bonds. And whatever the output of that or the effect of it is what it is. They're just going to spend 50 and that's it. What the Bank of Japan did, they said, hey, we're going to spend as much as we can to make sure the 10-year never goes above 0.25%.
That's held now, hasn't it? Like they kind of got tested a bit there. It's held, right?
Well, the currency,
absolutely.
right? The currency is the release valve. We're at 138 on the yen or whatever.
Is that that currency still weakening though over the last couple of weeks?
It's you're always going to get jibs and jabs going in there, but it's not strengthening at all.
So I've got a question for you, Keith. So you're obviously.
Wait, I got to jump into Europe. I'm not finished.
I have a question for you on Europe.
What's the question?
The question is, 50 basis points is more or less irrelevant with inflation at 8. What's your opinion of like why the ECB decide, like, it's just political to say, hey, we raise rates? Like what's the objective here? Is it to protect the euro? Like, I mean, their currency is getting smashed this year.
So it seems to me like they were very congratulatory with themselves today that they finally ended the period of negative rates in the Eurozone. That's it. I mean, it's no different. Like, Bank of Canada going from 0 to 2.5 or whatever. Like, that's not going to affect inflation. It's going to create something else. But the two key things with this today, with the Eurozone and the ECB, this new program, it is, from what I can tell, it's unlimited, but they haven't set a target on what they want to try to keep a specific market at. 'Cause remember, there's 19 countries, right? And they left the wording open that they will target public securities, but they've also left it open that they could target private securities as well. But the main thing is to be eligible to receive this be eligible to receive funding from the Transmission Protection Instrument, the TPI.
Bailout.
And they're already having it capital T, capital P, and a little written undercase I, because it looks cool, right? It looks cool. These are the criteria. You have to be in compliance with the EU fiscal framework.
Makes sense.
Which means, so the EU is Brussels. They set fiscal policy. No one is in compliance with EU fiscal policy right now. Every single Eurozone member has breached it. So with the Maastricht Treaty, I think it was a maximum 2%, 3%.
I thought it was 3.
Deficit, and then debt to GDP, all that stuff. No one's done that. You also have to have no severe macroeconomic imbalances. Like, what the hell is that supposed to be? All right. You have to have sustainable public finances. And again, everything is unsustainable right now in Europe. And the last one is to even have it in quotes. You need to have sound and sustainable macroeconomic policies, including complying with commitments under the EU Recovery Fund. So again, what this does, and people, again, this will they'll start to realize this soon. If you want to get your credits, if Italy wants to get the credit spreads to get tighter, closer to Germany, or come back under control, you have to listen to the EU. So whatever they're telling you to do, you have to do. And then the ECB will then use unlimited money to help bring your bond yields down. So you guys may not remember, but back in, was it 2012 or 14? So back then, the Prime Minister of Italy was Silvio Berlusconi. So he was probably one of the...
Bunga bunga.
Yeah, there you go. Like all of them, right? They all got hair attached to them. He refused to play ball with the EU, so the ECB stopped buying Italian bonds, and they went into crisis, and he got kicked out, and then he's replaced by Mario Monti, the technocrat. So an unelected guy became the Prime Minister of Italy. Today/yesterday, Mario Draghi used to be the head of the ECB. He was also an unelected Prime Minister of Italy. He just resigned from his post. So Italy's now into this, this summer of not love. It's not like Rich, it's not the summer of love. It's something different over in Italy right now. But again, everything is set up. The ECB tried to do things today to pave things over. And then the final thing, Steve, is that you brought up with the 50 basis points. The ECB specifically stated, because somebody asked him, it's a Dutch guy, he said, does this mean you're still going to do 25 basis points in September? Is that guidance still there? And they flatly said, no, we are no longer using forward guidance. We'll just let the data guide us for each meeting. So which means, then I said, hey, they're done. So I think right now the ECB has done one and they're done. They're at 0. They'll try and never go to negative again because it won't add any value. But that's my long ranting European story. It's trouble, guys.
We might have to mix it. We might have to mix in another Twinkie bet there. Anyways, go ahead, Rich.
Well, I just wanted to add, not that I feel like just to add a little bit of the context. I think, Keith, aren't they just they're committing to just keeping the euro together? And I think that's when you step back, I agree with you. It's weird that it's open-ended. It's there's a lot of fluff there, but ultimately they need those spreads to be within a certain range. They cannot have these spreads widen, and they've allowed themselves, right or wrong, a facility to keep those spreads tight, because ultimately if those spreads widen too much, you're in big trouble and the euro breaks down. But funnily enough, by doing this, by tightening and had an open-ended sort of fiscal and monetary policy. I mean, doesn't this sort of, unless there's a political, blowback, but doesn't this effectively bring the euro tighter together, closer together, ultimately leading to what they will need to make this project successful, which is fiscal transfers? In the past, I've made the comparison between Mississippi and California. Highly productive economy, not so highly productive economy. There's a fiscal transfer there. There's one singular monetary policy. And then as their constitution, that's something they agree on. And the more the ECB does this with the EU, et cetera, ultimately, aren't they just binding these countries closer together? Again, with the caveat, there might be a massive political blowback, which blows it all up. But short of that very real possibility, isn't it really just about bringing these countries closer and closer together, and ultimately a fiscal transfers and a fiscal pact? I mean, isn't that the real point of all this?
No.
Come on. It is. That's exactly what it is.
No, it's yes, it is the former. They're just trying to keep it together. That's
right.
all they're doing. Yeah, so they're trying to keep the eurozone together. They're not trying to. If they want to create this similar system what the Canadians and Americans have, they have to consolidate all the debt, and they need a central fiscal policy. They don't have that right now. They have 19 different sovereign debt structures, 19 different fiscal strategies, and all that. So just to demonstrate, how absurd it is, the EU yesterday they announced that they're directing all member states to reduce their energy consumption by 15%. Yeah, by 15%. And what happened, Steve? So here's a good example, though, Rich, on why Eurozone is screwed. What was the result, Steve?
Up. So yeah, it says Javier Blay was tweeting. Good reporter from Bloomberg. North versus South 2.0. He says Spain, Greece, and Portugal reject the EU's call for 15% cuts in natural gas consumption to help Germany. Spanish energy minister, clearly aiming at Berlin, says, quote, contrary to other countries, Spain has been living beyond its means in energy terms.
So I want to jump in there. It's delicious and rich, and I know it's sad, but also really funny, because during the 2012, 13, 14 and Euro crisis, the southern countries, so the pigs, or I know that's not polite, but Portugal, Italy, Ireland, Greece, and Spain were desperately asking for a bailout. They needed to fix their fiscal position. And Germany, stuck their nose out and said, we're responsible. We're not profligate. And we don't want to basically hand you guys a lot of money. And then fast forward 8 years or whatever. And it's exactly what this guy, Javier, what's his name? He's brilliant, by the way. And it's this North versus South 2.0. So it's so funny.
Javier Blay on Twitter. So it's at Javier Blay is BLAS.
He's great.
He's a really good, basically
that's
all
my
about
point.
energy markets.
And that's my point with Europe, though. Like, they will never agree on how to resolve something. So if they're never in agreement on how to solve something, by default, it's never resolved. It's very simple. That's the way I look at the world many times. If it's not this, then it has to be that. That's the way it is.
Oh, wait, it gets better though. It gets better. So we had Poland, also in the EU. Poland's government wants to use the central bank's record profit to help Polish households buy coal to heat their homes.
Yikes.
So I don't know if that's going to comply with the EU's climate change agenda. But anyways, that's just, Europe just sounds like an absolute basket case. I mean, hopefully they don't have a cold winter this year, because that's going to be a challenge.
Well, they're just going to start. They're just going to burn.
Yeah.
Sorry, quickly. They're just start burning more coal. I mean, the idea that they're going to just make their individuals suffer, and when they have an opportunity, they're just going to start burning more coal. I mean, that's already started to happen. The idea that they're just going to deal with this and tell everybody to not consume and have everybody in the cold, I think is not. I got this argument from an article I read the other day. I can't remember the guy's name, so it wasn't mine, but he laid it out. I mean, they can do it. The point is that they're just going to break their climate commitments, et cetera, et cetera. Sorry, Keith.
I mean, there's already a bunch of isn't there already a bunch of manufacturers in Germany basically having to like close the doors because the cost of energy is just not profitable at this point. So you're decimating that like entire economy essentially.
Yeah, the natural gas is used in manufacturing, you need energy in order to run the very energy intensive industries that some of these manufacturers, let's say steel, a car plant, I don't know, whatever it is. And if you have energy prices, remember natural gas is something like 8x what it is in the US. I can't remember. So you have like there are natural gas hubs in Netherlands and Italy. There's no liquefied natural gas terminals in Germany, I don't think. The UK has lots of them, and then the US is something called Henry Hub is the index that people look at. I'm sure there are other ones, but that's the one I look at. And in Europe, it's like 8x or whatever, 8 times more expensive. And you can, as a business, you can do that for a little while, but eventually it just becomes prohibitively expensive to do basically anything. And they've talked about rationing natural gas. They've talked about rationing energy. They're asking people to consume less. I mean, we've talked about this before, so let's not go over it too much, but it's just a massive own goal, right? I mean, again, they closed 3 nuclear power plants on December 31st, and they're about to close 3 more. I mean, it's just madness. Sorry, Steve.
Well, no, isn't the it says, I'm just reading another way. The French government is calling on citizens to switch off lights in order to conserve electricity. I believe that the French government also just recently had to bail out one of the massive electric utility companies as well.
Germany did too, actually. I think they just gave 2 billion euros to a gas company in Germany. I can't remember now, but it's just a real shame. It's really kind of incredible that such a rich, well-developed part of the world is dealing with a crisis totally of their own making. Again, Russia is obviously to blame here on some level, but to hand over a strategically important part of your economy to a nefarious actor, to me, is mind-blowing. Sorry, I know.
Well, yeah, I mean, what's amazing though is like, we did this show. We always just say, like we enjoy just talking about markets, and our goal was ultimately just to sort of help, Canadians understand like the world and how these things work. And like, as Keith said, like everybody I know in Canada is so focused just on housing, but like you have to understand the world to understand like what might influence our housing market here. And I just like, just chatting here, talking about these energy markets and this crisis that is unfolding in Europe. And then just to see like in Canada, thank God, for Alberta, that we had this standard of living that we're able to maintain. And I just see like the policymakers here, and it's like, man, are these guys just like not paying attention? Are they just that ignorant? Are they just not that smart? Like, do they just, it's just like, man, I wish we can get this show out to more and more people. I'm sitting here reading, it was coming across my screen last night. Like, this is just like pure insanity. In a 6-5 vote, Vancouver City Council approved spending up to $700,000 in 2023 on financing a class action lawsuit against, quote, big oil. So the city of Vancouver is spending $700,000 of tax money to sue big oil, as if like the CEO of Chevron gives any like shits about what some little tiny city in Canada says about, climate change. Like, I don't know. It's just, I don't know. I just kind of lost so much faith in government and policymakers, and it just kind of bewilders me. And like I said, that's why ultimately, we do this show. We're certainly not right about everything, but I think it's more just like having that dialogue, having these discussions. So like, hopefully we can inform the citizens of this country who ultimately are responsible for voting these people into power, right? So the next time you get up to the polls, hopefully people can make educated decisions and ask educated questions about the people that they are electing into power.
So that was nice, Steve.
My rant for the day.
That was really good.
Me. My property taxes are going up to so we can sue big oil. Like
they're gonna target the king of Kitsilano on his house. Just one final point here with Europe, which ties into what you just mentioned as well, Steve. Countries are always copycats. So especially in the Western world, if the governments are all leaning in the same direction, so in Canada, we lean more towards socialism, same in line with Europe. The ECB today, they are not projecting or projecting any recession this year or next year in the Eurozone. They think they're going to sail on through this. I think they'll be outright wrong. If they are wrong, and they already have all these other programs in place, do you want me to read them out again just to make sure?
No.
No?
You're gonna have to add this to the bingo card.
I know it's a big one. The transition protection instrument.
Anytime Keith
Like no one's gonna
So-
no one's gonna tell you they're going to go in recession though, right? I mean, come on.
Well,
No?
I know. Yeah, I agree. They have to. Well, they could say, hey, we think the risk is. What they're saying though, they're saying we think the risk is to the downside with growth. So they're downgrading growth, they're upgrading inflation, but we have it under control because now we have 0% interest rates. Plus, we've created this, word salad bailout program that has no quantitative information whatsoever on the term sheet. But what I suspect will happen next, the area is, again, I do not have a very good view on what's going to happen in the Eurozone. I think it will ultimately break up. But the next step, though, is that they're always going to try to save it. They all have an incentive to keep it together. And I think you will get to see helicopter money coming in Europe next. That's the next phase that will happen. Canadians should be very interested in that, because those in Ottawa right now, they're following the European story extremely closely. And if we start to experience stress here in Canada, and the Europeans have success with helicopter money, and the success will be measured not does it help the economy, does it help household? The success is measured as, can they send out the checks to the right people? Get them cash. So that's all it's going to be. But I suspect we will be the second derivative coming up of that. So again, all this stuff it's proceeding right on cue where we're headed, which is in line with central bank digital currencies, of course. Which, if they have
your
that in
carbon
place,
footprint.
yeah, all this
On your
stuff
credit
is
card.
going.
Can I just give a market spin? So we've talked a lot about the economy, we've talked about macro and policy and politics, but just to give people a little bit of market context, which I think is fascinating throughout all of this, which is the market's actually tentatively finding some sort of bottom. And like if you look at, we look at relative to rates of to moving averages, we look at relative strength index, advanced decline lines. And throughout all of this sort of negativity, you're starting to see a little bit less volatility, and you're starting to see, who knows, a tentative bottoming out. It could be a bear market rally, whatever. The other thing I think is fascinating about the euro, and despite all of these negative sort of headlines, obviously the energy policy is bad for manufacturers in Germany. The euro is hitting parity, et cetera, et cetera. If you look at earnings revisions and earnings revisions ratios for the European equity market, they continue to grind higher, which I think is actually fascinating. Whereas in the US, it's actually starting to roll over. I think the cheap euros are starting to have an impact on analyst expectations for earnings of 2023. And it's funny how sometimes I mean, Keith, you say this a lot, but the market and the macro can be disconnected and dislocated. And I think we're starting to see a little bit of that now.
Keith, how are you looking at markets right now?
So we have a pretty good equity model that we use. There's a primary model and a secondary model. And, you can never, tick the bottom or top of any market. That's not going to happen. But as of right now, two of them combined, they're still suggesting weakness or caution in equity markets. Maybe a few weeks from now, it's a weekly model, so it'll adjust every week. Maybe it'll start to show some improvement. It's not deteriorating anymore, but it's still in that, sort of zone where, we're not excited yet. When we get excited, we'll tell everyone, hey, yeah, we're now in, after we do the trade, of course. And that's the way it will work. But, because we were chatting earlier, is this a bear market rally, or is it, really it's the bottom has troughed and we're going up? And we won't know, with hindsight. We'll see. But I know the last few days it's been pretty good for investors, because a lot of people were really hurting the first half of the year.
See, I don't see any near-term bottom in Canadian housing. If anyone's asking or wondering, I think we've got quite a bit to work through still. But that's my thought. So I mean, I'll leave the stock indices to you. But
so the risk we have is sort of, so yesterday, so I was at my desk I work at quite early in the morning. I get started. So yesterday morning I'm at my desk, I'm doing my stuff, and all of a sudden I sneeze, and my entire left side of my neck just froze. It just seized up. That's what happens when you get close to the boomer status. And I said, "Oh my God, what am I going to do?" And it was like 5:30 a.m. Like nothing was going to open another few hours. I literally couldn't move. I couldn't lie down or anything. And Mrs. Icecap, she was not that sympathetic to me at that hour in the morning. Anyway, because I was able. Normally it's a great story. Normally to get in to see someone, it's a week wait to get in. But I told him I know Steve Saretsky, so I jumped the line. I got in right away with my physiotherapist. That's fixed. But the reason I tell the story is that if the U.S. does experience, like if they sneeze, if they catch a cold, they sneeze, the rest of the world will catch a cold. If the U.S., if they sneeze now coming up, like the economy, does come to a bit of a halt, which I still think the probability is a lot higher than what they're thinking. This sort of rally in Europe and all that stuff, it's going to roll over again, pretty hard. So remember the data coming up over the next few months, ISM data, PMI data, maybe not so much employment data, because that might be a bit, you sort of got to really cut through that and see how it's looking. But again, we could have some slow numbers coming up. And if the Americans roll over, it's going to be tough everywhere.
I mean, well said. It just kind of leads to a couple quick bullet points. Rich, maybe you can kind of chime in here as well. So they got, I don't know I know you're on vacation, so I'm not sure if you have the data in front of you, but U.S. jobless claims hit 8-month high as the labor market cools. Initial unemployment claims increased 251,000. Continuing claims up 51,000, largest advance since November. Reading a release here from AT&T. So the AT&T stock price declined the most in 20 years. Basically, the company announced that they are expecting free cash flow of $14 billion. About $1 billion difference was due to the tied to the timing of customer collections. Basically, what they're saying is they're expecting people to sort of delay and be late on a lot of their cable bills and cell phone payments. So, I mean, that's kind of maybe a little bit illuminating as to the state of the U.S. consumer. I still think that's one of the biggest lies, is like, oh, the consumer is in great shape. I mean, they say that in the U.S., I think, and then they say it in Canada. I mean, I know that the U.S. is certainly in much better shape than Canadians, but I don't know. I mean,
they're not terrible though. I think often I think we get sucked into these very stringent positions when I think sometimes the answer is something gray and fuzzy in the middle.
Somewhere in between.
I think that, there's a lot of talk about how real wages are negative. And yeah, sure, if you use some wage growth numbers and some inflation numbers, it's negative. I can give you one real wage growth number that's positive and rising. And so you have to, I think the truth is probably somewhere in between, which is, U.S. consumers have a strong balance sheet. Employment is strong, but lagging, but there's definitely stresses, which is obviously inflation's a stress, obviously delinquencies, who knows, charge-offs, there's obviously claims going up. And I think the answer for the consumer is probably somewhere in the middle. This idea that they're definitely bad, I think is wrong. Just like I think people who say they're definitely good, I think is wrong. I know maybe that's a boring answer, but that's the way I call it. I don't know. We didn't talk about China. Sorry.
Yeah, for sure.
I know we're running out of time, but we didn't talk about China. Maybe for next week, but there's lots of stuff going on there. I don't know.
Well, yeah, I mean, we obviously
sorry to tease that.
No, I think it's a good. I think we talk a lot about the sort of Canadian housing bubble, and I think that the Chinese property bubble is certainly up there. I think it's probably larger in many circumstances, but there's definitely a lot of stresses emerging there. They've been running COVID zero policy for quite some time, and obviously that makes it quite difficult on a lot of these developers, right? Trying to sell, new construction development, pretty hard to do if everybody's kind of locked into their house and the economy is not really moving. So in China, we've recently seen apparently how it works. Again, I'm not the Chinese expert here, but basically they have to, when you buy a pre-sale condo development in China, apparently you start your mortgage payments while it's under construction. So like you're actively like paying. And I believe those payments actually go to the developer. So a lot of Chinese residents have decided to stop paying. We've talked about it briefly, on the show, I think last week, about the Chinese property bubble and some of the largest developers in China having, missing bond payments and going through some restructuring, but tanks are now being put on the streets in China to protect the banks.
It's amazing. I would recommend anyone just go Google that. It's wild. You see like a bunch of tanks in front of the banks while people were protesting. And what's actually amazing about China, people, I'm guilty of, saying it's a communist totalitarian, this and that, and people don't have a democratic voice and what have you. I think what we're actually watching is kind of a wrinkle in that narrative where you're seeing individuals making the choice to withhold their mortgage payment, to protest, to actively sort of voice their, political dissatisfaction in a way that I think is actually kind of surprising and fascinating. Something we should definitely keep an eye on. I wonder how Xi Jinping, who's going into, I think in October, there's the, Politburo or the party conference or whatever it is. I mean, this is a really interesting sort of wrinkle to be happening right before he's meant to get his third term. And it'll be something to keep an eye on for the rest of the summer for sure.
Did they have the election yet? Did he win?
I mean, I guess we'll find out in terms of capital flows, right? Like, I mean, Vancouver will be a popular destination for offshore haven if you're trying to get your money out. So I haven't seen anything yet. Certainly the luxury market's still, like the rest of the market here, is quite weak. But basically,
I was chatting with people in Hong Kong and in Singapore last week. Money can. So this is anecdotal, but I'm also seeing it from the macro side as well. Money continues to gush out of Hong Kong. It's just flowing out. 5 of the last 6 days, the Hong Kong Monetary Authority, they've been, selling USD, buying HKD, like hand over fist. Their excess reserves, they might have maybe 5 weeks left at this rate. Like that's how close it is. CNY, that top end of that range gets adjusted every day. And this is important for Canadians. 2 things. If you're not happy with your mortgage, it shows that you can go demonstrate in front of the bank.
With all your fixed payment variable mortgages that are going to get triggered in September.
Yeah, be careful though.
Expect tanks.
Expect the tank in front of the bank. I know a guy once who sank his bank, so that's pretty cool too. See what we're doing here?
The real convoy.
But for Canadians though, the potential housing crisis in China, if it was triggered, it would be about maybe 10 times bigger than always for what the Americans had. It is enormous. And the reason people have stopped making their payments in China is because the developers have stopped building. They stopped developing. So like they're not going to, keep pouring the money into a developer where nothing is coming out of it. So they have some concerns over there right now, and we're seeing we're seeing it on both sides.
Keith, how much of that do you link back to like the strengthening of the US dollar in terms of creating these market stresses as well? Not just like COVID zero policy and a bubble that they've inflated, but it's kind of like there's always got to be like a spark, right?
Yeah, everything is synchronized right now. Like people talk about, the Chinese miracle, how they could do this or that. It wasn't a miracle. They were a country and economy with very little debt. And all of a sudden they opened up their economy for foreign investment. Money came pouring in. Whatever money came pouring in, that they'd levered it up 10, 20, 50 times. And it just became this enormous growing economy based on debt, no different than what the Western world did, except the Chinese were able to do it, at a stage when the rest of the Western world sort of peaked. So the stronger dollar, it does hurt it, absolutely. But yeah, I mean, with rates going up in the US. So for example, I lived in Bermuda for a long time, and people don't know this, but the Bermuda dollar is pegged to the US dollar. And if you go to exchange it, it's not one for one. It's a little small smidgen you have to pay. It's called the foreign currency purchase tax. But you get paid more interest to keep it in Bermuda dollars, versus US dollars. But the moment something goes funny, you're thinking, okay, where am I going to, which currency do I want to hold in my pocket? Bermuda dollars or US dollars? It's the same thing over in China now. Like, would you rather hold Hong Kong dollars in your pocket? So remember, you're in Mexico in the dark alley and something goes wrong and you whip out a pocket full of Hong Kong dollars or US dollars. Rich is in trouble with these Hong Kong dollars, and Steve and I are leaving the alley safe and sound because we paid up USD. That was a bad story.
That's wise advice. Always hold US dollars.
I know.
Your Canadian dollars are no good here, sir.
I think Rich is playing like water polo or something soon.
Well, I gotta go.
Classic. He's got another boat meeting here.
That's right.
All right. Well, we'll wrap it up there. As always, we appreciate your guys' support. All we ask is that you share this episode with at least one person and continue to build the Loonie Hour community. Plenty more to come. We'll see you next week.